Good day, traders. Stacey, Burke from Stacey Burke Trading, returning today talking about the setups. So the setup is what's important. It doesn't matter which instrument you trade. We're going to look at some examples on the major pairs today. After yesterday's video, I received a ton of questions, and I'm just going to go back and focus on the real basic concept. For me, I am looking for the setups at the session opens. And the high and the low of the day. I get this question over and over again. How do you know you're at the high, or how do you know you're at the low? But it's about the setups, cataloging your setups and understanding that I want to be selling high into an open if I'm looking for a market to go to the high for the sell, or the market has already locked in the high, and then I'm getting a retest or a stop hunt inside of that high for a blow-off move, trap volume. I'm looking for an area where there may be a session low as a target, or a larger geometrical structure of the entire day, where now we're going to get a breakout for a measured move, which again comes back to the daily charts, looking at breakouts where breakout traders are trapped and they may be revisiting the other side of a daily range, so the previous day's highs and lows. So if we just go back and have a quick look at yesterday's notes, I talked about 1 hour a day, and basically when I have that move, you might be in some markets, NASDAQ and gold can move 50 to 100 in one direction and maybe move 50, 100, 250 in the other direction. It just depends on how long you want to sit at the screen. But I'm looking for typically on those pairs, if I'm in early, maybe 75 pips once I'm in the U.S. session, or a high or low of the day setup, 75 to 100 plus, depending on how good my fill is and the setup. High of the week, low of the week, you might be in at the very extreme of the range. But it depends on the instrument. Most of the major pairs, you're going to be looking at 25 to 50 in that range, and depending on the setup, it just may be a 25 pip move. But we're talking about trade setups where the market has locked in the high or the low, and it's going to burst. So that's different than me sitting in a creeping trend back and forth, back and forth, back and forth, to scalp 20 to 30 pips or 15 to 20 pips in a creeping trend where I can't even go to break even. I'm talking about a market that's going to explode. I'm positioned in there. I know, or I have confidence that that market is coiled and it's going to explode, and those are the trades that I can scale up in size. These aren't situations where I'm looking and hoping that it moves in my favor. I'm looking for a market that has established the high or the low, revisited it, locked it in, or I'm in a broken market, so it's falling, they've already locked in the high, it's a broken down market, they're retesting the high, and it's going to fall over, possibly have a measured move, whatever that may be. And again, there are different setups, but it's about the setups. So I talked about the importance of timings. And we'll look at some examples of where even inside of these timings, there may be nothing because the setups just aren't there. It may be a 3-session setup, or it may not even be a setup on some of those major pairs for that day. It just may be not an ideal market to be trading. It may be establishing that over 3 days, 2 to 3 days, whereas gold, NASDAQ, typically we're going to have 1 to 2 really good trades minimum, depending on your availability and screen time. Now, me being in Western Australia, I have the opportunity, for the most part, to see the majority of Asia, London, and the early part of New York. Now, I don't stay up past 11 o'clock, so I'm really only there for that first 3 hours max. And often there are trades at the close of New York, some very big moves. But again, coming back to understanding the setup and the importance of timings, I'm looking for something to be set up in this first hour to 2 hours of the market. Sometimes it can be a third-hour trade, especially in London. It may be an hour of movement, an hour of consolidation, and then an hour of reversal. And those reversals are where the market has trap volume and it's going to move very quickly. High day, low day, we're going to talk about that today very specifically. I'm going to show you the 1-minute charts and how simple this can be if you step back and then just scan through the markets looking for the best opportunities. I don't sit there and wonder, is this the high or this the low? I draw my lines and then I stick to the timing window. So if it's outside of the timing window, I'm already looking for a market that potentially has broken out and going to fail, or broken out and going to trend, or it's inside and I need to wait and watch because the setup isn't there. Primarily double zeros and 50s. Now that doesn't mean that the market can't go to 75. That what that can be is a breakout to 75 that fails and they coil volume above 50 or below 50, whatever that may be, for trapping volume at a quarter level. It may be above double zeros to 25. Again, we'll look at some examples. Time compression. So when the window kicks in, it might be 7 minutes to the high and then 7 minutes back for the entry, or 9 minutes, and you're in the market in that first 15 minutes because that's a 5-minute maybe pin hammer or a 10-minute engulfment. And on the 1-minute chart, you'll see that. But it's important to understand that can be a pin bar on a 15-minute chart. Time compression is very important. You might be in a move in the last 15 minutes of an hour, and that market may be proceeding now to move for a full hour. And it's important to understand that if you do not want to counter trend a market once we're in this 3-hour window, if it makes its move, and if you're counter trending, you better have that as part of your playbook, because that counter trend move, you might be in a measured move and get smashed. It's very important to know the setups, and that counter trend can be outside of a previous day's high or low, but you want to make sure that that's not in a breakout versus a vertical stop hunt market. A vertical market will burst out, trigger breakouts, consolidate, and reverse, and possibly go back all the way to the other side of that range from daily high to daily low. Whereas a trend trade may break out and continue to move, and you do not want to be mistaking those. Time compression. So understanding time compression, especially when you are at the high and low of the day. So if we look at gold, now we talked about gold yesterday, just, the build up over the week, the template. We'll get more into that in one of the future videos, the templates. But every day, you may not have traded this move. Most people may not have. They may not be trading Asia. But once we go into this gap time, the market stays inside. There's the low of the day. At this present moment, prior to the Europe window, if we were coming to the screen in Europe, this low is our low of the day. Now, this is the high of the day, but as this market broke down and broke higher lows, it also formed for the Asian session a high of the day, and as it auctioned lower, we saw lower highs of the day. Now, people can have different names for these, whatever we call them, swing highs, swing lows, but they are when we go into the gap time, and this is our most recent low of the day, and this is our most recent high of the day. Now, again, I'm coming to the screen possibly for the Europe window if I didn't trade this. So prior to the Europe window, we have a lower high taken out. And prior to the Europe window opening, we have a new high of the day, which we'll just adjust here. So the market has made a low. So just prior to this pink window, which is my Europe 3-hour window, again, refer back to the timing window. This is the high. This is the low of the day. Now, this, although it forms a higher low, which again we'll talk about in a moment here, and this forms a higher low, what I am concerned about is this, because this market could take off and go all the way back up here. But I want to work from the low of the day or the high of the day. Now, I'm down low. The market has dropped down 100 pips and gone sideways. Now, hypothetically, again, before this session opens, we can say that the low of the day may be locked in at double zeros, major round numbers, 50s and double zeros, which we see straight off the bat. This was we'll zoom in on this because this is a really great example of where the market, and there are people who would have shorted this right on the open, and I'll explain why. This was a good 20, 25 pip scalp. The market went up above the the 25 level just prior to the last hour before the 12 candle window, so I talk about the stop hunt hour. We get one push up, pin high. That's the high. The pin there is the high. We'll just bring this down. This is how I approach the market. I know there are high of the days up top. We're talking about 50s and zeros. And I'm looking for them to possibly be selling down into the low. And I'll explain why. So we have our pin. We retest that. They drop it down and they go back up and they engulf it. That potentially now tells us that they've locked in a high above 25. So just stepping back, coming back here one more time and looking, this is the low. We'll call these lower highs, knowing though that if when you see lower highs, you know you want to be looking for a buy low opportunity. They're bringing you down low and getting you to sell it down into the low. But that said, right off the open, if traders were looking for this and the high being locked in, they come back up into the high. Okay, the high is locked in. We've got a low locked in. We got our peak formation, double zeros, 1, 2, 3, and then a vertical W formation locking in double zeros. And then we have a 3-push pattern locking in 25 as the high of the day. Now this is a 1-minute chart, but if you've been trading these markets and you know what you're looking for, as they came back up, there were traders selling the pop-ups into 25 to scalp this move down. Now, I'm not looking for this type of situation. And I'll explain why. This was an easy scalp for 20 pips, 20 to 25 pips. First 15 minutes, time compression again, so you'll notice that the low is at 908. 908, 907 is the halfway point of a 15-minute bar. 1 push, 2 pushes, 3 pushes down, okay? But this candle, so first 15 minutes is down. I talked about first 15 minutes is often a false move. We can draw a line anywhere in here on these lower highs as a trapped box down low. The second 15-minute bar opens, and we get a pin hammer inside bar. It breaks above this consolidation. The market hits the high, so we have a stop hunt down through the consolidation. So again, consolidation, stop hunt. We got a consolidation, we got higher lows. This is a dead giveaway. They're going down. They're getting people to buy inside, and then bang, they hit all the stops. Trigger breakouts possibly down at the low of the day, but they're getting you to sell into the low of the day. They reverse the market. They hit the stops, trigger breakouts on traders that are going long at the break of the high of the day, and immediately come back inside. What that does is it puts 25 pips of heat into a breakout trader, which, again, for the average retail trader, 20, 25 pips, no big deal. I had somebody ask a question, great question, why wouldn't you rather trade the daily charts and go for 200 to 300 pips? Well, I still want to go for 200 or 300 pips, and I'm going to show you that on gold. But if you're doing that on a daily chart, your stops are going to be, maybe 150, 180 pips on gold or NASDAQ, maybe more. And so for the average retail trader, I don't know how you would carry any sort of size into a trade with that size of a stop. But I do know how you can trade in a coiled market off a level for 25 to 50 pips with a 10, 12, 15 pip stop with size, and know when that market potentially is coiled to accelerate or blow off, and be in the move as it's accelerating with size for 50, 75, or 100 pips, and be taking some of that off as it's moving with very little stress, because these markets will move super fast in the direction of the trade once they have the volume trapped and they've hit stops, whether that be on the inside or the outside. So the market goes up, triggers breakouts, drops down, and coils sideways. Now, again, timing, we're at the end of the first hour. The London market opens on this candle bursting to the upside. Now, again, this is not a trade setup. Ideally, this is tradable, but this is not the type of market trade high day, low day. We have the low locked in. This is a trade that people can take, 25 obviously up. It's a coil on, if you're using EMAs, there'd be a coil in there. This is a great trade. But it depends on on the setup. So this is a trade setup that I would be willing to take, but I wouldn't necessarily pile a lot of size on. I would put size on this knowing that I have a strong conviction, but I'd be looking for 25, maybe 25 and 25, 25 up, 25 down, and maybe call it a day, although obviously there's another 25 up. But we'll talk about the difference between this type of trade and then when we have a high of day, low of day locked in and the market moves and goes into free fall. Now this is a great trade. The low is locked in. They break out, pull back, go into consolidation, and explode up for 25 pips. The market, again, this first 15 minutes takes traders up. Now you'll notice we're at 50. Major round numbers. We'll zoom in a little bit more. So these are all tradable. And so there's, again, just coming back to gauging the potential for a large move versus a 25 to 50 pip profitable trade, maybe 75. Now on a major pair, if you're going for 25 pips, I want to see that market coiled up, locked in a high or a low to blow off, probably as quick as this, 15 minutes, and be willing to, know that I can put some size on with conviction. So, as I said yesterday, I'm a bit more of a short seller than I am with trend trades. I like to see these right down low if I'm going to be buying it, coiled in at the low or coiled in up at the high. Now, we get our first 15 minutes, and the second 15-minute bar opens up inside and then retests the high, giving us our middle structure. Now, you'll notice we come up 1, 2, 3, and then we get a bear pin hammer. So for these people who say that the 1-minute chart is just noise and everything else, you honestly don't know what you're talking about. This is an extremely calibrated, well-orchestrated market, and these setups show up on every single pair. And if you're using longer time frames, 15 minutes, 5 minutes, you can see you're going to be getting filled somewhere halfway or later. If you're buying a 15-minute bar, you're getting the close up here. You're buying at the high. The 1-minute guy is gonna take this initial. Okay, so we're in a broken down market. Coming back to that first move down. So I'm looking possibly for a short back down into the breakout because we had 15 minutes up. And if I'm not in that move up, so typically again I'm only gonna maybe 2 trades in a session. With a day like this, I'd be happy maybe to walk away with the 25 either up or down. Yesterday I shorted this. Again, I just like to go. I let the first 15 minutes of London open up. We got up to 50. They retested the high. I shorted this. I caught part of the move down on the third push. This was 3 pushes on the 15-minute. I just happened to catch it, and we'll look at that in a second. So this move down, this move up, both clean trades. Again, the person who shorted the third tap to the high, again, we're getting later into the session. Still a good trade, but you can see they came down and put a low in that third hour, and then 3 pushes up before engulfing it, and then the big move down. So coming back to structure, we painted a box in the upper 25 pip box. So 2 things to just ignore price for 1 second and talk about timing and geometry. Timing, okay? 3-hour window. We move the market up and hold it up there. It's not going any higher. They're going into 50. We're getting selling at 50. They're trapping volume, buying into the high. They engulf it, go sideways, and break out of this range. They break out. So we know we have a low of the day. We can call this a 25 pip box. Just to retouch on, somebody asked me how to set my fib numbers. I've just got 50%, 100, and 100% expansions. I just changed the numbers. I deleted the fibs. I don't believe in that. I don't use them. Everything is super simple for me. I'm not making this complicated. I'm not interested. It's range expansions, and then also knowing where the low. This is yesterday's low right here. Just this blue line. I'll put a green one right above it. That's yesterday's low. Now, we hadn't broken that yet. We went down. That's the low of the day. We haven't broken yesterday's low. That's the low of the day from Asia. but we have a geometry, we break out. So this, I just happened to notice when we were coming up and this was starting to come down, I just happened to notice, I was just flipped my screen back on, I noticed they were engulfing, and I sat there and I said, that's a 3-push pattern. And I was looking at these higher lows and I thought, this is going to go all the way down, because I knew that we had that level from where the pump and dump began the night before. And I entered into this market with just reduced size a bit, but enough that I felt that we were going to revisit the low. Now, timing, we're going to talk more about the gap times and stuff, but again, just talking about setups. Sell high. Timing, 15 minutes up to 50. M structure, boom, sell. There was a coiled market. They locked in the low. The low was locked in. W down, breakout, pullback, consolidation. London opens, goes vertical for 25. 3-hour window. 1 push, 2 pushes, 3 pushes into the high. They drop it down and go sideways. This market now does a measured move. 2 expansions down, takes out the low of the day, hits the quarter level, and then coils in 3 pushes, pulls back. Now, in the previous video, I talked about the gap time and the hour and a half prior to the U.S. session. Now, you'll notice that this pin hammer is at the second 15-minute bar 2 hours prior. So this is a dead giveaway. This timing, this hour, okay, the 1300-hour chart time, it's roughly, this will be 6 to 7 a.m. New York Eastern Standard Time. They locked in the low. The low is locked in. So knowing this, if you've studied this type of setup enough, now we'll come back. Again, remember, they came down and went sideways. Put in a lower high, hit the stops, triggered breakout traders short, pulled it back, locked in the low. Once they've locked in this low, and again, we're not even in the U.S. session yet, they lock in the low and proceed to auction upward. Where do you think they're going? Okay, they're going to the high of London, and then we also have our trader who is short in the Asian session. Now, how do I know this? Because I've done this and seen this enough. Heading into the U.S. session, if you aren't long down here, the higher you go, the less likely I am to trade this. I would look for something like this in this hour and in the hour prior. Double zeros, pin hammer, knowing that the low is locked in, and then timing. So first 15 minutes is down of the hour prior. Second 15-minute bar locks in the low at double zeros and proceeds to auction up. My thesis would be in this move, as it was yesterday, this will accelerate up quickly to the high because they're going to get traders and hit the stops on the traders who are short in Asia. But the beautiful thing, if you came to the screen in the U.S. 12-candle window, very important, the market is moving up here. We know that there's a profitable trade up at the double zeros from Asia. We know that double zeros potentially could act as resistance. The second 15-minute bar closes right here. 1, 2, 3 engulfment at double zeros after stops have been hit as the new third 15-minute bar opens. We have higher lows all the way up chasing this move. Lock it in. This just falls. Boom. Now, we're in an upward move, in an upward, longer time frame market. We look at gold on the daily. We know this market is blowing off. You're shorting into a vertical moving bullish market. If I'm shorting into this move, so again, look at the timing of this candle, these candles coming down. We're 10 minutes down, little bar, 25 plus pips, I'm locking that in if I'm shorting it up at the high on the engulfment at double zeros after stops have been hit. So important to understand that. If I'm in the long trade, coming back off the bottom, I'm getting out on the high when that engulfment happens. It didn't explode through. It reverses, third bar. It locks it in. I'm out of that trade. I'm done. I don't even stick around for the New York Open, but we will look at the New York Open. 9:30 New York time. This is the 9:30 New York candle right here. So higher lows, they hit the stops, trigger breakout traders, get people shorting the market. most important thing to understand about the New York Open. The first 15 minutes will often be a false move back against a trend or to a high or a low to hit the stops. If the high is already locked in and they come up in three bursts, so again, 3 bursts, 15 minutes, we get an engulfment on the second minute of the second 15-minute bar at the quarter level after New York has opened. They've auctioned up in 3 pushes, 1 push, 2 push, 3 pushes. Okay, if you can't tell from price, use the clock. Now this pin hammer is key. This is a pump and dump. Pump, 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 engulfment, second 15-minute bar, short, boom, 25 pips, minimum. Okay? 3 pushes into the low, you can hold on to that. Okay, you might get 50. It depends on the setup. This is a Friday night. They've already gone vertical. They've hit all the stops. We're inside now. We're inside. If I'm inside, I'm looking for 25 pip scalps if I'm trading this late. The only other time that I'll be there this late is if New York has coiled down at the low or at the high for the open. Because now I know I'm looking for possibly a big, 150, 250 pip move to the other side of the range. So just taking a quick look at the NASDAQ, I read a comment the other day about, the NASDAQ, super dangerous, the volatility, if you don't know what you're doing, you blow your account out. Totally agree. But understand the simple concept. Yesterday's low. They trigger the low prior to the Asian window opening. They pull it back inside. We got a massive squeeze inside the low at 50 after they trigger the previous day's low. This low, okay, basically the same low, but they went up vertically, bang. When they go vertical, okay, I want you to just pay attention to the space. This is a dead giveaway right here. The space, the size of that vertical candle. That space is an area that if they coil the market and hold it up here, it's going to go vertical through that. There's nothing to stop it on the way down. So they bring it up high, and they get traders to trade in the upper box. They put a high in place. It goes higher. Okay. During the Asian session, they go higher. So what do? I mark my high of the day. Oops. Mark my high of the day. This is prior to the Europe window. Okay, we got a high. They've come down and made higher lows. Okay? Before the session opens, they break that, and they creep lower into the Europe Open. Okay. So they go back up. Now I have my new low for Europe. I draw my low. They come down. They go up in London. So again, you can see we're inside. There's the high. There's the low. Now, could this be the high of the Europe session? Absolutely. Why? Because of the timing. 3 15-minute bars to get up to the quarter level. The fourth 15-minute bar. Okay, we'll zoom in on this. We got lower highs from the Asian session. Okay. Could it fail there? Absolutely. So, timing-wise, time compression. Third 15-minute bar closes up high. Right here. This bear pin hammer is the first bar of the last 15-minute candle. Okay, they've triggered stops on the lower Asian highs. We're at round numbers. We got a 50-pip box. We are up high. This could go all the way down. Okay, I'm going to short that. Wow, this could go all the way down through the low 300 pips. A full range expansion, that's basically a 100-pip box. Okay, but what happens? We short it, comes down, pulls back, first 25, and goes vertical down through the lower 25. Now, again, understanding, if you watch how this market's set up, anything that's caught in the middle like this, and people are buying up and not getting out up here, they're caught if this market falls. So recognize when these higher lows are there, because this is a type of market that can do a measured move. Now, if we go back and look at gold in the Europe session, okay, they came right back. 25 pins, they pinned into this level. We had a consolidation. Okay, we had a consolidation and a breakout. On the NASDAQ, we had a consolidation, but we had a squeeze going vertical. So this is the sort of market that it can fall right back through to where that move began. So you might have took 25. You might have held on to it because 25 and got back in for the second 25. It doesn't matter. You thought it was going to go 100. It gets down to the low and reverses off the low. We're out. But with the NASDAQ, one of the most important things to understand is that it's a New York market. When is it probably going to move? I love the fact that this market, unless we're at the high or low of the week during Europe, is largely predictable that New York is going to be the big move. So what I mean by that is that if we come back and we look at the week, okay, again, you'll notice London and Asia are inside. They're inside of the Asian range. Okay, they broke out in Asia. They went down and put a low of the day in. Okay, so here's my high, here's my low. So they broke out, creeping trend back up. This is a sell area. Okay, everything in here, people are trading this. This is where you get chopped up. This is the chop. This is the low. Okay, this breakout area could act as the high. So my numbers here, 50 to 75, could be where I get a high put in place. Come back to timing and understand time compression. Okay, they go up. The first hour ends. They go vertical in the first 15 minutes. 3 pins to the high and an engulfment at 10:13. Somebody's going to position themselves up here, first entry. Why? Because of the timings. 1, 2, 3 on the final leg. They might not go huge size. They get in, it drops down. They add another one. Drops down again at 50. They go sideways. The second 15-minute bar is getting closer to closing. They're positioning themselves above 50 now, locking in these upper ones at break even. So forget price. Once you know the higher the lower locked in, focus on the level and the timing. So we see all these higher lows, this creeping trend up. That's why a market will go vertical. We have stops all the way up there. Okay? That's a 75 pip move. That's actually a 100 pip box where that pump and dump started. Boom. 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 Okay? This could go. It might fail. It might fail right here, which it did initially, but then it eventually pushed through. Okay? So the closest hour where the pump and dump starts, I'll mark my first level there. I'm looking at the round numbers. Okay, it could fail at double zeros. It pushed 100 pips from top to bottom. So you might take some off and hold on, thinking that this could pull back and retest the low, and you lock in some profits, leave a trailer, give it to the end of the hour. This is 45 minutes, this last pin. 45 minutes from the London session, the first hour of the London equity market. So these are all important factors to consider. The timing is everything. So coming back to the big picture, again, high and low, high and low. London puts in a higher low. Another giveaway that this possibly is trapping volume up high. And 6:31 New York time, same time as yesterday, they start the move back up. 12 candle window gets people buying up into the high. What does a trade look like? Okay, the high is locked in. Engulfments. 1, 2, 3, engulfment at 50. I'm selling this. Now, some of these charts and platforms may not match the same prices. Some of them are just slightly off in terms of the number levels, and they're 10 pips or so. But on this platform, it's 50 pips. They short it. The market drops down. Again, we got higher lows. Higher lows getting caught up top. Bang, 50 to 0. Done. First hour. Continued measured move, another 50. So you're in a broken down market, a market that has the potential. Why? Look where the pump and dump started. So these are the setups. You want to see a market go vertical, possibly lock in the high, the previous day's blue tracer. They were already above that during the session, but I project that line across. Okay? They go up, fail, creeper back up to double zeros, failure, breakout. Now, this upper box where they break out can now become a resistance or a selling area. It's the setups. It's not hindsight. It's setups and timing. Timing. Engulfments, pin hammers, bang, bang. New York opens, bang. Another 75 pips. This is a market that's going to keep falling. So there are some markets, when they're set up, if they're broken, we know NASDAQ is potentially now rolled over. We could be at monthly lows now, and anything's possible. But When you're in a broken market, again, I talked about looking for markets that are set up to fall or to blow off. So if you're in gold, it was extremely bullish. We've had all this talk about in Russian invasion of Ukraine and all the protests happening globally and stress and inflation and all these things. Gold being a hedge, I don't really pay attention to any of that. I'm looking at my daily charts. So if I go back to my NASDAQ, again, it's broken down. These are big bars, big bars, big bars. Okay, so 1, 2, 3 on the daily chart. Triggered breakouts, trapped people on the long side, hit the breakout trader that was short, stopped him out. This market had the potential to fail at the high where the breakout traders were caught from Tuesday's high. Study the daily charts. Study these setups. Coming back to just that concept now of the box again, if we look at this high-low, we'll just go number to number, 50s and double zeros. Okay, I can talk about just even one full range expansion, but this did 2 full range expansions. This is where you can make money. So you might have this thesis, you lock in 50 or you lock in 75 or 100, but you leave a trail or you sold the high of the day, the high of the session. This thing has the potential to close down at the low. Why? I don't know. But no news, nothing on the schedule. This is the type of market, though, when it falls this strongly, let it run. Let it run. So it doesn't matter. Again, we'll talk more about the templates, looking at the bigger picture. When I come to the screen each day, I'm not looking to trade Aussie dollar. I'm not expecting much movement. Same with the euro, but when there's a setup there, okay, so I just draw a high and a low. I've got a broken level on it from a daily high. They've broken out. They've consolidated it. All I'm looking for is, have they hit a level when I'm in the gap time? I'll come, an hour and a half before. Am I at anything significant? Well, what's significant? Double zeros, 50s, high or low, previous day being hit. Typically, those levels will be right near a major round number or a quarter level. So we see the markets auctioned all the way down. So we've had, more than 25 pips of movement. They've gone down to a level which was a low of the week area. So if we just scrunch our chart up on the Aussie dollar, again, Monday right here, pink line, Monday, Tuesday, Wednesday, Thursday went vertical. Okay, day 1. Day 2 breaks out, previous day's high, day 3. Day 4 goes vertical. Day 5 comes back inside, gives us our first red day. Okay, they go down on this is the previous week. Monday, they lock in the low of the week. W at the low of the week. Come back and break out on Tuesday. Higher Wednesday, so day 1, day 2 on Wednesday, day 3. Lock in the high. Revisit it. Friday, they go back up to the high. They break out. Lock in the high. Okay, so coming back to our 1-minute chart now. I'm coming along maybe in the U.S. session. Why? Because I talk about looking for setups that occur over the high and low of the Asian range. Thesis is this. Asia puts a low in place on this particular day. London puts a high in place. Okay? We have a 50 pip box. Okay? We have volume trapped above double zeros. This is before the U.S. window. What is my thesis? My thesis is that they broke out of the previous day's high and reversed, came back up to it, locked in the high. This could be a bit of a head and shoulders, possibly. We have head and shoulders in Europe. Is the high locked in? Possibly. Okay. They come up in just before the U.S. window in that last hour. They give us an M at the previous day's high, and we said we think the high is already locked in. Oh, I don't know what to do. Where do I get in? Anywhere up here. Okay? If you don't get in up here, and we stick to the timing window, the market breaks out at the New York Open, but look what it does. As I said, breaks out in the first 15 minutes. Stop hunts back up in the second 15 minutes. Okay? The next hour opens up, and what do? They lock in the high above double zeros. So this is an example of where we get to the market, and if you didn't sell up top, right? You don't. If you're selling in here, you're selling inside. You're inside. You think it's going to go, and it might, but the problem is you're inside the high and the low of this range. You could get caught in a vertical move. They break out, so we wait. We're patient. We're patient because they're going to go down. They're going to get this. The people who are long in Asia. Remember what I said. If you see a vertical candle and they shift it up right away, that means everybody's got to be buying higher. They're buying higher, okay? So they go even higher and lock in the double zeros in Europe. That means now everybody up top, if this market fails, is trapped. They trigger breakout traders on this first breakout, first 15 minutes of New York. Trigger breakout traders come back up, consolidate, lock it in. Now we can get in. If you're not in up here, we're getting in here with the thesis of this is going to go off to the low of the day minimum, 25. 1 push, 2 push, 3 push. We got an M triple top. They come back again and give us another M. This engulfment after the pump, lock it in. That's the second candle. Zoom in on this pattern. The second candle of the second 15-minute bar in the new hour. Now, you see this right here? This pin into this is the stop hunt into the guy who shorted the engulfment. Then it takes off, locks in, so you can focus on price action, but once you know they've locked it in, I position myself as best fill as I can above the numbers with the spread. Why? Because if I'm chasing it, I know I'm going to keep getting further away. So again, ideally, I'm looking to get in up here, right here, as this going vertically. I'm looking for something to give me an entry at the previous day's high, because they've already locked it in. That's an area where they've already sold it off from. They've already put it in the peak formation, and then it's all about what happens right there in that last 15 minutes right before the session opens. First entry's up here, breakout pullback, they drop it down. You could add in more here. When New York opens, I wait for the market to open, because it's gonna either blow off all the way down, and I'm already in, or they're gonna trap people. 1 push, 2 push, 3 pushes. Second 15-minute bar opens, bang, 1 push. This pump up is the giveaway, because now what this forms in the middle of the box, higher lows, we're not at numbers, is a geometrical structure for a measured move down. And there's your trade. So just looking at some various examples, we could look at the pound yen. Again, if you start to master this 1 minute chart, so just to give you an idea, okay, there's the high. I put a high in place. There's the low of the day. Obviously, we have lower lows, but when you're trading in here, you're getting whipsawed. Okay, if it trades down, I need to watch how does it behave. Does it give me an entry? I'm not just buying this down at the low because it's down at the low. I need a reason to get in here. And again, now, so I'm talking about markets that are going to go vertical. So this may not be an ideal setup. No, it isn't. This is why, again, I talk about NASDAQ and gold, because they give you, like, for all this time and effort on some of these pairs, this takes a long time for 20, 25 pips. But here we go. They go to the high. They engulf it and lock it in. Guess what time? That's the third 15-minute bar. So the last 15 minutes gives us our M structure for a sell of that first hour. They went up. They hit the stops. They higher low. There's your minimum structure for a measured move down, middle structure. But obviously, low of the day is probably going to be our first target. It may not get there, so low of the day is there, but we had our W locked in from the low of Asia. Okay, it gets 2 full expansions. Short, New York opens, bang, they take it all the way down. 1 push, 2 push, 3 push. This consolidation is a dead giveaway. You want to get out of that market. And if you're trading later in the session, the vertical move back up. 1 push, 2 push, 3 push, consolidation, pin hammers, engulfments, pulls back inside of the range, continues to accelerate. They put a low in place at double zeros for the explosive move back up. So all these other time frames, I don't buy it. I don't try to align it with This is the BOE news candle. I don't buy that with, aligning all these other time frames. I know that people will disagree with that. I look at the daily chart. If I'm going to trade something, the first thing I do is look at the daily chart. I want to know where there's any open gaps. I want to know if there's any traders trapped from previous days, breakouts of highs or lows. I want to know, am I in a strong market? Like we looked at gold, it's going vertical. So if I'm going to trade something, I'll look to the daily chart right away. I want to know where the bias is, if there is any bias whatsoever, if it's a sideways or choppy market. Then I'm purely looking for the setup. So again, if we were to look for something on the euro, just like basic process. Again, I probably primarily would be looking at the U.S. session. Why? Because I know that in most cases, unless we're at the high or low of the week, and it's gone vertical, this will be a 3-session type of setup. And I'm looking for, again, a blow off 25 to 50. The market breaks out in the London hour, makes our M formation at the high. So if I came in the U.S. window, my thesis could safely say that the high potentially now has been locked in. They put a low in place. They break out of that low. They go down and break out of the low of the day, break out, pull back, and they start to fall into the U.S. Open. Prior to the window opening, I'm short. I'm short all day long. They've locked in the high. Break out, pull back. And then they lock in the pullback at the lower high of the day, and it starts to fall into the open. So as it's falling into the open, I'm in either right away or I'm in on the pullback. And again, talk about timing. Okay, there's no free lunch. It's not just going to go straight down. It auctions down to the numbers. Okay, 30 minutes down, 15 minutes up. Third 15-minute bar opens, engulfment, it's already falling. I want to get filled at better than 50. And my thesis is, of course, we're going to revisit possibly the previous day's low. First area that this could fail was the breakout level. And again, we talk about timings. New York opens and auctions back and forth, hits 50. So if you were in this move and you get filled and they come back up at the New York Open, you can get back in. Get back in now. We're looking for the 25 down. Okay, we get towards the end of that third hour. Bang, they hit the stops and fall again. But just, I'm just looking. It doesn't matter. I'm looking for markets that are broken, and I'm looking for markets where they set up into the session open, no matter what it is. The same process every single day. Not cherry picking, not hindsight trading. The process. Where's the high? Where's the low? Okay, there's no guesswork. Mark it off. If you're not sure, then maybe there's no setup. High of the day, low of the day. They auction up. They break structure. They lock in 50 maybe. They break the low again at the Europe Open. They auction it up. 3 pushes, it fails and breaks down. Okay? This is the Euro. It breaks down, but then this is the London Open up here. Okay? 9:55, chart time. They engulf it at the London Open. Put a false low in place. The high's already locked in. Okay? High's locked in. They come back up in 3 pushes and engulfment. So whenever you see this inside of a high or a low, this is pump and dump. Pump, 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 engulfment. We're short. Second 15-minute bar of the London Open. Boom, free fall. I don't know. That's even on the Euro. This is a decent trade. 37. You're getting. They put a low in place. They put a low in place and go below that low with a little bar down. You're thinking it's going to go to the numbers. They go 1, 2, 3. I'm out of the market. It's also timing. So timing. This is the third 15-minute bar opening, going down 1, 2, 3. I'd be locking this in somewhere down here. You're looking at 25 to 30 pips. So again, coming back, just review this process. High a day, low a day. No guesswork. It's the setups. I'm looking for something to be locked in. I'm not guessing to get in front of anything. I'm looking for something to be locked in and coiled for an explosion, an explosive move. Again, if we come back to the Euro, there's a great example of this. Just in closing, a little bit longer today than I expected. Wait. Draw your highs, draw your lows. Okay? Let the market move. Let it do what it wants. People are shorting this on their 15-minute and everything else. Okay, the market takes out the low of the day, goes down into an existing low. But see, there's our high and our low. But more importantly, let's go and look at timing. Okay, they go down and put a low in place in the first hour, and guess what they do at the London Open? They come down and engulf it in the last couple minutes of the first hour. London opens, bang, pulls back inside, goes vertical 25 pips. Okay, they put a low in, breakout pullback, engulfment at the low of the day. Our first target is going to be where that move started, high of the session, and then possibly even get to the numbers. It gets up there, we're out of the trade. So again, hopefully you got some value from today's video, traders. Stick to the high and the low, the timing windows, understand time compression. It's about the setups. So build your playbook. Again, I'm probably more comfortable shorting stuff. Sometimes I'll, positioning myself in a trade like this, just to give you some feedback. I'm in the market right here. I'm in on this bar, but I'm not in super heavy. When it comes above this box, if I was taking this all the way back to the high of the day, if that was my thesis, back to the high of the day, I would be adding in some size back inside of the low, but that would probably be it on this type of setup. Now, if we go and look back at NASDAQ, okay, this is a great example of where I'm looking for the short. Okay, I'm looking for the short. Okay, my thesis is this. I want to see them pump it back up into the high. It's already a broken down market. This market is down. Okay, they went vertical. We're already in a downward market. They went vertical. They've retested it into that box, this level. They come up. They hit the stops. Okay, now study these charts. This is order flow for a big move down. This one push, two push, creeping trend back and forth into the high at the open. Boom, engulfment, heavy, adding, New York, adding more, boom. So every time I get a short, I'd be going in super heavy up here. Super heavy on this type of trade. That's me. Would I recommend that? No. Just start mastering the process. But this is an ideal market. It's already broken down. We looked at the daily. Thesis being they've, two things. One is that it could have revisited the low from last month. Somewhere over in this first pin somewhere down here. That is still my thesis that they are going to go down there. We'll see what happens. We're in a broken market. This could keep going lower. I would have to probably see some two-way trading, maybe Monday, Tuesday, maybe if it's going to reverse. But right now this is heavy. I think they're dumping it. And if we come back and scrunch this up, market's got plenty of juice maybe to, I don't know. Anything's possible. But that's a lot of movement. So again, high and low, keep it simple. Didn't mean to talk so long today, but it doesn't matter what instrument you're trading. I'm waiting on the outside. If it's inside, I'm small in size unless I know they've coiled it and locked everything in and I'm in a box that's possibly going to now do a breakout for a range expansion in the right setups there and then look to increase size. So stick to the window, master the process. Don't be greedy. Don't be sitting at the screen for hours on end. Keep it simple and stay out of the inside. Have a great trading session, and may the markets go with you.
Hi, traders. It's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High-Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.